Welcome to Odisal Associates Accounting and Finance Tutors. We are in a series discussing common accounting mistakes small businesses make that will lead to problem in their businesses. We have discussed about inaccurate financial records, mixing personal and business finances together, poor cash flow management, and failing to plan for tax or taxes. These are four mistakes that we have discussed earlier. Today, we are going to focus on another deadly mistake that people make in their businesses that might make the business to collapse or not to run the way it's supposed to run or not foster growth. Inadequate accounts receivable management. Account receivable refers to the money owed to a business by customers who have purchased goods or services on credit. This means the business has delivered value, but payment has not yet been received. Before, we used to call it debtors, those who are owing the business. That is simply what receivables mean. The people who bought from the business or the people the business renders service to, but these people have not paid the business. So this is called accounts receivable. While offering credit can increase sales, poor management of receivables can destroy a business. Many small firms close down not because they are unprofitable, just like we are talking about poor cash management then, but because cash is trapped in unpaid invoices. Cash flow is the lifeblood of any business. And once it dries up, even the most profitable business can collapse. Now let's look at how to understand the account receivables. Understanding accounts receivables. Accounts receivable, or in short form AR, represents one of the most important short-term assets in a business. However, it becomes a problem when payments are delayed endlessly. You sold things on credit expecting to be paid in a week's time, in 2 weeks' time, in a month's time, but this payment is not coming. You call the customer will give one excuse or the other, or you even forgot that somebody is owing you. Payment is delayed endlessly. Two, customers default. They have promised to pay, but on the day of payment, they defaulted. Three, follow-up is weak or non-existent. You are not calling your customers to remind them of their debts. You are not calling your customers to tell them that they are owing you, they should pay. You are not even going there. You just be waiting for them to pay you. There is a weak follow-up in such situation, or follow-up is non-existent. There is no clear credit policy. Another thing that can bring problem in receivables is when there is no clear policy on receivables or on credit. Credit is supposed to have policy. If you meet those criteria, you can buy on credit. But where you did not meet, then you will not buy. They will not sell to you. So if there is no such clear credit policy, it means that every Tom, Dick, and Harry can buy things on credit, even when they don't have what it takes to be given credit. We used to have the 3 C's of credit increased to 5 C's of credit. We talked about character, talks about capacity, and all the rest. Small businesses often struggle here because they prioritize sales over collections. But remember, a sale is not a sale until the money is in your bank account. Even though accountants will recognize the sales when the sale contract has been concluded, it does not mean that you have actually made a sale that will increase the working capital of your business, because until the money comes to you, some uh, credit sales can turn to what is called bad debt. That is, the customers may not be able to pay at all. And when that happens, you write off the debt, because you cannot continue to carry receivables that you cannot recover. Now, when ARO, account receivable, is poorly managed, cash becomes tight. There will be paucity of cash, no money to do all sorts of things. Bills will pile up. You cannot pay the people you are owing. Even salaries you cannot pay. Suppliers begin to demand payment. And because payments are not made to suppliers, they will start making demands. Some can take action against the business. And eventually, the business can no longer operate smoothly because of poor receivable management. Common mistakes in account receivable management. These are some mistakes that we make in account receivable management. A, granting credit too easily. Many businesses give credit to anyone who asks, just to encourage sales without checking credit worthiness. You invite bad debts. So before you give somebody something on credit, you must check that person's credit worthiness to confirm that this person can pay, has the capacity, has the character to pay. If not, then you cannot give such credit. That's one of the mistakes people make on credit sales. Just sell so that our sales will increase. B, delayed or irregular invoicing. Some businesses take days or weeks before sending invoices. If you delay invoicing, you delay payment. Customers won't pay until they are asked. Of course, if it is you, if you know that you can buy something on credit and delay that payment for a long time, will you pay? You will continue to wait until they ask you to pay. And the legal way of asking your customer to pay is by sending your invoice to them. Once you send invoice to them, it means that the invoice has started reading as you send the invoice to them. Weak follow-up. Businesses sometimes feel uncomfortable asking for their money. They only follow up when the situation is already bad. But consistent, polite reminders are part of professional practice. Yeah, it would be like, he's our customer now. Don't worry, maybe he doesn't have money now. That's why he's not paying. It's not true. Follow up whether the person does not have money and let him remember that he's owing people. So every time you refuse to follow up or you fail to follow up, you are making a terrible mistake that can harm your business. So that's it. D, not having clear payment terms. Let anyone who is buying from you know your payment terms. This is the maximum number of days my payment can stay with you. After that, you must pay me. If it is 10 days, if it is 1 day, if it is 2 days, 3 days, 10 days, 1 week, 2 weeks, 3 months, 1 month or so, let it be clear that this invoice is due on or before a certain time, so that the person will start planning towards paying you. E, ignoring aging reports. An aging report shows how long each invoice has been outstanding. Many small businesses don't review this, so they don't know which customers owe them, most of which debts are becoming risky. So when you age your receivables, you are trying to calculate how long your invoice has been with your customer without being paid. 30 days, 60 days, 90 days. So it is when you age your invoices that you know that the invoices that are overdue for payment. So if a clear record is kept, you will age your invoices. This one has lasted for 1 month and the customer has not paid. This one has lasted for 2 months and the customer has not paid. Meanwhile, your term of credit is 1 month. So in this way, you pursue the invoice and remind the customer that his payment is overdue so that he will pay. The F1 is overdependence on a few customers. If one major customer delays payment, the entire business suffers. Over-reliance increases vulnerability. When you rely on one customer or one big customer, you have a problem. Because once the customer delays payment, the entire business will suffer. Consequences of poor receivable management. One is cash flow problems. Even if profits look good on paper, lack of cash means you cannot pay salaries, restock, or run operations. If you have cash flow problem, like we discussed in the third video, it means that you might be making profits, but you will not have cash to settle bills. And this is a very big problem. You might not even have cash to restock or to do some administrative or operational expenses. This is one of the biggest problems when you don't manage your receivable properly. You will be short of cash. Then there will be increased bad debts. When customers fail to pay on time, the probability of default increases. So when you have increased bad debt, it will erode your profit. Your profit will go down because those bad debts will be regarded as expenses for the period and written off against your revenue or your profit. 3, it will lead to higher borrowing. To survive, businesses start taking loans, often with high interest rates, which further worsen the financial situation. If you don't manage your receivables adequately and your receivable piles up, because there are bills to pay and to settle, you will resort to borrowing money. And most of this time, you borrow money at a short-term notice because the expenses are also short-term expenses. And this will lead to higher rate of interest. Maybe if you borrow money from bank, you can negotiate the rate of interest you pay. But if you borrow from all these loan sharks, they will tell you what it is. And because you need the money, you won't mind that interest, but you pay the interest rate. The fourth one is poor supplier relationships. If you cannot pay your suppliers because customers haven't paid you, your reputation suffers. And your suppliers will not want to supply you with some credit again. They will demand that you pay them first before they supply. And because you don't have cash, it will be impossible for you to pay them. Sometimes suppliers will now put interest or markup on their goods because they know that you are not a good creditor. You are not credit worthy. So you borrow higher than you borrow if you did not manage your receivables. Because your receivables, when you collect them, you increase your cash and you use them to pay your debts and also pay salaries, restock your goods. It could lead to business failure. Eventually, the business may collapse due to inability to meet obligations. So because you have all your money tied in receivables, you cannot pay. If you did not pay, it will lead to shutting down because you may not be able to restock again. What are solutions? How do you manage your account receivables effectively? That's what we're going to look at now. One, implement a robust account receivable system. This includes clear processes for issuing invoices. You must have a clear process. If I sell my goods today, I will invoice today. Any day I sell my goods, I must make sure I invoice. Not just invoicing, invoice accurately. Because when you invoice and there is error, they will return your invoice for you to re-invoice again. And when they return it, the aging will drop and it will start counting again for them from beginning. You, in your own book, the aging will increase, but in the book of your customers, the aging will drop. So while you are counting 60 days in your book, they might be counting 15 days because they returned the invoice for you to re-invoice. Implementing a robust account receivable system also involves tracking outstanding payments. Tracking outstanding payments. Now, your invoices that you sent, you have to look at them every time to see the ones that have been paid and the ones that have not been paid. Those ones that have not been paid, you make sure you track them. Oh, this one has not been paid, though it's overdue, but it has not been paid. Establishing follow-up routines. Now, if you have tracked your invoices that are outstanding, you establish a way of contacting your creditors so that they will pay up, either by phone or sending a receivable officer to go and demand your debts from the company. Maintaining proper documentation. Now, for you to track your outstanding invoices, there must be proper documentation. So this is very, very important. In order for you to manage your receivables, you must have effective account receivable system. Using software like QuickBooks, Zoho, or Excel can make things easier for you. Regular and prompt invoicing. That is a second way of solving the problem of receivables management. Regular and prompt invoicing. Invoice immediately after delivering goods or services. This will include due date, payment methods, any early payment discount, penalty for late payment. So this should be part of your invoicing. The invoice must have the due dates. This invoice you are sending must be paid at so date. Then the payment methods, whether it will be bank transfer, by check, by cash, or whatsoever, you will include, including your account and all the rest, account number. If there is a discount that you offer for early payment, you should include it in the invoice. If you pay within 30 days, I'll give you also discount so that the customer can cash in on this discount plan and pay. Then you should also add penalty for late payment. If you don't pay as and when due, I'm going to charge additional 10% or so. Establish clear credit policies. Define who qualifies for credit, maximum credit days, credit limits for customer. So it's not everybody that qualifies for you to give credit. And then you should also set the number of days that your credit should stay. Any customer that buys from you 30 days, you must pay within 30 days or at the end of 30 days. Create limits per customer. Every customer will be treated according to their ability to pay, according to their character, according to their capability and capacity. You treat them that way. You are not going to give a flat limit for everybody. Some people you can say, okay, this person I can give you a credit limit of 10,000. This I can give you a credit limit of 100,000, depending on who the person is. So you must have profiled your customers to know the limit of credits that you give them. Train your staff to enforce the credit policy consistently. Having a credit policy is not enough, but the ability to enforce it is very, very important. If you cannot enforce your credit policy, then it is just on paper and will still not do anything for you. Follow up on overdue payments. We should use structured reminders such as reminder a few days before due date, reminder on due date, first overdue reminder, second overdue reminder, phone call or visit, legal or collection action for very late cases. So we must follow up our payment, especially overdue payments. We must give a reminder to our creditors some few days before the due date that your payment is due in 4 days' time. On the due date, you call the person again, your payment is due today, please make your payment. If it's overdue, you remind him the first time, remind him the second time, make a phone call, visit him, and if he does not comply, you might need to take a legal action. All these processes, you should be consistent in them, not over aggressive. Consistency is the key, the best way to follow. Use aging reports. Review aging reports weekly or monthly. This helps you to identify slow paying customers, anticipate cash flow shortages, take action before debts become bad debts. When you have aging, you will know customers that are not always paying on time because you've aged their invoices according to customers. You will be able to know when there is going to be shortage of cash flow and make provisions for it. Then you will also take action so that your debts will not become bad. Another thing to consider is that you might factor your invoice or seek for invoice financing. If cash flow is tight and customer pay slowly, consider sending your invoice to third party at a discount. Say invoice of 50,000. You tell another person, please, this person is owing me 50,000. This is my invoice, but it's not paying now and I need money. Can you pay me 45,000? So you take the invoice, he will pay you the 50,000. That's factoring. Invoice financing, using unpaid invoices as collateral to borrow money. These options help you access cash immediately instead of waiting. So sometimes you can use this method. Do invoice financing by going to bank, keep your invoice with them, and borrow money from the bank. When they pay, the bank simply collects the money that you are owing them. So let's have some practical tips for small businesses. 1. Avoid giving unnecessary credit. 2. Always verify a customer's payment history. 3. Keep communication professional and timely. 4. Reward early payments if possible, maybe with cash discount. 5. Do not ignore overdue invoices. Act fast. Yes, this is about it. In conclusion, inadequate accounts receivable management is one of the hidden killers of small businesses. Many firms are profitable but still fail because their cash is locked up in unpaid invoices. By implementing a strong system, maintaining regular follow-up, and using available financing tools, small businesses can protect their cash flow and significantly improve their chances of long-term survival. So, my listeners and my viewers, you have seen that managing your receivables properly will boost your business. But inadequate management of your receivables can lead your business to collapse. So we must manage our receivables. Receivables being the people we sold goods on credit that have not paid, the goods we sold on credit that have not been paid, the invoices we gave out that have not been paid. So this is where we're going to end today's topic. You should continue to follow us, continue to share, Continue to comment. In the comment section, you can ask questions. We are going to respond to you when you ask questions. Subscribe if you have not subscribed, so that we will continue to bring you topics like this. Thank you and God bless.